Hello and welcome to this pre-recorded webinar. My name is Yves Shu from Affluence Private Wealth, and today I wanted to talk to you about investment strategies for doctors and dentists. Look, it's probably an opportune time to talk about this because as I'm recording this, we are in the midst of the coronavirus crisis, which has obviously severely affected investment markets and people's portfolios. So probably a good time to talk about all these different investment related topics and principles. So hopefully you find this useful. And if you have any questions after the presentation, you can obviously email me or call me. But hopefully this should give you a really good understanding of what investing is like. Obviously, I'm not giving any particular advice in this presentation. You should seek your own personal financial advice before making any decisions, and I'm not recommending any particular products, obviously, as well. So, Affluence Private Wealth is my business. So, I provide financial advice to doctors and dentists. Mostly, our clients are between the ages of probably 30 to 45, primarily. So, young families with a lot of different challenges, including financially. And then my business partner Mitchell looks after Affluence Chartered Accountants, which is essentially a tax and accounting firm for doctors and dentists, where we also help clients start up their own practices or purchase dental practices, for example. But let's head into the presentation. So in summary, I'm going to be talking about different investment principles. I will also cover ownership options for your investments, which is really important, obviously, for doctors and dentists in terms of tax planning and asset protection. And then we will have a look at different investment options and ideas as well. First of all, in terms of investment principles, one of the key ones for me is compounding. So essentially, this is where your investments work for you over time. And you start to earn your interest upon interest, for example. It's a really powerful principle, and we will look at an example as well. But really, the main message in relation to this is that you should start early. So obviously, paying down your home mortgage is really important, but just as critical is really to start investing and to start building wealth from a really young age. We obviously have to be mindful when investing that we're doing it in a really tax efficient way because you would already be paying a significant amount of tax before you can invest. And then it's also very critical that we protect our assets because obviously being a medical or dental professional or a practice owner puts you at risk in terms of being sued, for example. Now, if you have a look at this particular compounding example, it's really powerful. The text basically speaks for itself. So you have a 20-year-old and a 25-year-old. They both start with $5,000 to invest. Their average return will be 8% per year. And then on top of that, they will be making ongoing monthly contributions of $200 per month, which is obviously not a lot. And that's really critical. We're not talking about a lot of money. 10 years later, the youngest investor would have more than $45,000. The older investor would have less than half that amount in investments. And so that's only 5-year difference as well. But then fast forward by the time you get to age 70, you can see the 20-year-old investor would have $1.6 million in assets. The person who started 5 years later would only just have over $1 million. So we're talking a difference of more than $500,000. So this is obviously where the power of compounding works to your advantage. The earlier you can start, even if it's a few years, even though we're only investing $200 per month, the difference can be quite substantial. So that's really one of the key messages I wanted to impart to you today is that you should start thinking about building wealth from a really young age rather than waiting till you're in your 50s, for example. Now, some other investment principles. For me, the keys to success, having witnessed very successfully financial people that I've worked with over the years, these are some key things that you should keep in mind. And if you follow these rules, it's really hard to make any big mistakes, if that makes sense, because likewise, I have seen people lose a lot of money by making the wrong investment decisions. Diversification speaks for itself, so make sure you have a wide range of assets working for you, whether that's in your superannuation or in other environments. So, for example, I'm not a believer in the fact that you should accumulate a massive property portfolio, for example, and then retire on that. I personally haven't seen anyone do that successfully. Uh, Costs matter as well, so it's really important to be mindful of the fees when investing, both in your super and other managed funds, for example, that you might use. Investments nowadays are a real commodity, so there's no reason to pay a really high fee for any investment products at all. The third one, discipline, works in a number of ways. So, first of all, we've seen the discipline in terms of making ongoing contributions, albeit they might be small, say $200 per month, but also discipline in times like today where we have investment markets all over the place, being up 10% one day, 7% down the next day. So it's really important that we keep our cool and that we don't end up reacting emotionally to all these things that are happening externally. So it's really important to stay the course when you're investing, because if you miss out on a couple of the really good days or even weeks in the stock market, your overall return will look a lot less attractive than if you just stayed invested in the market, because it is extremely difficult, if not impossible, in my point of view, to time the investment markets. Now, the final point I want to make there is extremely critical, and this is where people make really big investment mistakes. I'm a big believer in the fact that investments should be liquid, transparent, and simple. Liquid means you should be able to liquidate them fairly quickly. So, a typical managed fund or shares you can liquidate within a matter of a few days, and you can get your cash fairly quickly. Some investments might only trade monthly or quarterly, or even some property syndicates, for example, or more sophisticated investments. You can't really exit until they've run their course, or until you can find someone that will buy you out. In times of global financial crises, these investments can lose a lot of value very quickly, and typically then you can't even exit from them. So just be mindful of that. Transparency and simplicity. So again, just understand what you're investing in. Keep it really simple. There's no need to have really complicated products or investments. If you look at Warren Buffett, probably the most recognized and most successful investor in the world, he keeps things really simple. He understands in businesses that he deals with on a day-to-day basis and that he can understand. And there's no need to overcomplicate investments, because the more complex, the more uncertain the outcome will be in times like today, when there's a lot of turmoil, for example. So this slide goes back to the point that I was making earlier, to be disciplined and to make sure that we don't just sell out of the market when we panic, because the market can bounce back really quickly. Like sometimes the market will go up 10% in one day, like we've just seen in the last couple of days prior to me recording this seminar. If you miss out on those couple of days, even missing the 5 best days will set you back quite a bit in terms of the return. So you can see here, if you sell out and then you stay out of the market, and you're really scared to get back in, you may actually end up losing a lot of money compared to just remaining invested during that time. Now, when people make investment decisions, unfortunately, they typically start with the last bit. They start with the investment because they've heard about a particular investment, they've read about something, or their mates have told them about this really It's a really exceptional investment opportunity. And then people just jump in without considering, what are they actually investing for? What is their time frame? What are they looking to achieve? Who should own the investment, from a tax point of view and asset protection? So I've seen numerous doctors invest in potentially lucrative investment opportunities in their own name because they didn't talk to anyone and they just thought it was a good idea to do that. So just be really mindful of that, that the ownership decision is really critical because it will determine obviously a lot of the tax outcomes. So if you get a 10% return but it's invested in your own name, you might lose half of that in tax, whereas if it was in super, you might be paying 10, 15% perhaps. Or if it was in any other entity or your spouse's name, for example, you might have paid no tax at all. So really, really critical to consider that carefully. Asset allocation. So this is where we decide how much of our capital we expose to investment risk. Typically you invest in shares and property to get a higher return. Now, the way we split our assets between growth and defensive assets, being cash and fixed interest, will determine more than 90% of the eventual return that we get. So as you can see, this is probably the most critical decision in the whole investment piece when it comes to your performance or your return, is to how exactly are we going to split those assets, across the different opportunities and options. And then when we've gone through that entire process, it actually becomes really simple what the actual investment should be. So for me, that's the right way to go about it rather than starting with the actual end result, which is the investment. So we talk about ownership options as well. So from a tax and asset protection point of view, so I'll cover a few of these, being your spouse, using superannuation, family trust, or an investment bond. Spouse can be a good option because they might have a low tax rate because they're not working, potentially, and looking after the family or only working part time. The major issue I've got with it is that it doesn't allow for any future tax planning. So if you start to accumulate a lot of assets in your spouse's name and those investments grow in value and produce more and more income and capital gains, then in the future you will have no options to split that tax because at that point of time you might have stopped working yourself. And then obviously there's no way to transfer those assets to you in a tax effective way or to split the tax position. So it might be a good short-term solution, but in the long term, I think it just doesn't offer you those tax planning opportunities. Likewise, if you're concerned about control or being able to make decisions around your investments, well, if they're in your spouse's name, then typically you wouldn't have that level of control, which potentially, if things go badly in your relationship, may become a bit of a risk as well. Where it can work to use your spouse for ownership of assets is with regards to the family home. For example, you may put 99% of the home in your spouse's name and then 1% in your name, which still allows you to control that property in terms of mortgaging it or selling it, for example. But obviously, from an asset protection point of view, you're only exposed for 1% of the value of that home. So that typically can be quite a good solution if you'd like to protect your family home from any claims in the future. Superannuation, great because it's got a low tax rate, offers excellent asset protection as well. But obviously, the main issue, particularly for younger doctors and dentists, is the preservation of super, which means that we will not be able to access our super until well into our 60s, I would imagine. And there's obviously a lot of legislative uncertainty as well when it comes to superannuation and how it's being taxed and when we will be able to access it, the options in retirement. So it's critical from that point of view to understand, okay, we need to build our super, but I'm also a big believer in the fact that we should be building assets outside of super to provide more flexibility in the future as well. Family trust definitely very useful for a lot of our clients. It can obviously be a business structure for your practice, but it is very flexible as an investment vehicle as well in terms of tax planning options in the future. Allows you to keep control behind the scenes of the assets, even though you're not the legal owner. You would still be a beneficial owner of that asset. Really good option, obviously, where you have tax effective beneficiaries such as adult children or parents, for example, who you can split assets with in terms of the tax position. So overall, I think it's a really great tool for tax planning and also asset protection. And as a consequence, many of our clients have a family trust as part of their overall structure. Investment bonds can be a good alternative for education funding for children. The tax rate is capped at 30%, which makes it quite interesting. For example, where you have a medical or dental couple, both clients earn high level of income, pay a high level of tax. There's no real tax effective beneficiaries in terms of children or parents, for example. And so an education bond or an investment bond may be a really good vehicle because the tax is limited to 30%. It's very simple, so there's no setup costs or accounting fees like you would have with a family trust. The downside is there's limited investment options. But having said that, many of our clients have either an investment bond or education bond or both as part of their overall wealth creation strategy and structure. Because not one of these is exactly right for everyone. So typically, we would use a combination of all these options for our clients, where they are maximizing their super contributions, they're building wealth in education or investment bonds. And then for some, a family trust might be more beneficial because the children are older, for example, or there's some family members that we can split income with. So obviously, really critical to seek personal advice, but the ownership of your investments is a really important decision to make. Now, for the final piece of our presentation, just wanted to run through some different investment options. So we'll look at typical super investments, we'll look at property, shares, managed investments, and then some other options as well. So in terms of superannuation, very popular strategy for a lot of our clients in private practice is where they own their own rooms through their super fund, so through a self-managed super fund, whether that be with a limited recourse borrowing arrangement, so essentially a super loan, or whether that be just outright. Really good strategy. Obviously, again, not suitable for everyone because you need a fair bit of super. There's more ongoing costs for a self-managed super fund as well. But definitely for many medical and dental professionals who want to own their own commercial premises, should be definitely a consideration. In terms of other super funds, so when we're talking about industry super funds or otherwise, many of those have interesting investments that would not be available to you as an individual investor, particularly in the form of alternative assets, being private equity. So these are companies that are not listed on the stock exchange but might be experiencing high growth. Infrastructure such as airports, tollways, ports. So, as an individual investor, it's really difficult to get exposure to these, but through your super, because super funds have such a large amount of money to invest, you can participate in those types of investments very easily. And a lot of super funds will also be using hedge funds, which are obviously more sophisticated. And again, as an individual investor, you would need a large amount of capital to be able to invest on those by yourself. So within your super, you might be able to access different investments that can complement what you're doing outside of super, for example, and can provide you with additional diversification. Now, quick word about shares. Obviously, like I said, we're in the midst of the coronavirus crisis. Shares are very volatile, can be up, 10, 20% in a matter of a few days, and down as well, obviously. It's a really simple model, though, to invest. Obviously, you have direct ownership. You invest in a particular company. It's low cost because brokerage is really low, particularly if you use just an online broking account. Um, Australian shares come with franking credits, so can be quite tax effective from that point of view, particularly in superannuation. The main issue is obviously diversification. If you buy one share, say Woolworths, then you miss out on all the other companies on the Australian Stock Exchange or even in the world. So it can lead to concentration risk, and your performance as a result can be very different from the benchmark. So let's say if the Australian share market goes up 10%, your share might go down 20% or might be up 15%. So the experience of one individual share versus the overall share market can be very different, and that can be good, but can also be really bad, obviously. Property, in particular residential property, is very popular with many doctors and dentists. I feel it is heavily over promoted by some advisory and accounting groups. So I'm not a big fan of residential property. I've seen a lot of clients lose money in the process. The rental return is typically quite low, particularly after you factor in all the different costs and expenses. And obviously, one of the biggest issues is that you typically acquire property with quite a bit of debt. So if you invest in a number of different properties, you might end up with a large amount of liabilities, which is not ideal, particularly if you're heading into retirement. That debt needs to be repaid. And if the property does not go up in value, then obviously you're still left with that same amount of debt as well. What I do like about property, because it's not all that bad, obviously it comes with a lot of tax benefits. It's easy to get finance for, so it's easy for you to get started. Typically, you just need to cover 10% of the purchase price and then additional costs in terms of stamp duty. And it can be a store of wealth, So I was talking about some successful clients and investors who I've worked with over the years. Many of those have had an investment property that they have paid off over time. They didn't have multiples of them, they just had the one. They've paid it off over time, was a form of forced savings, with the tax benefits and the tenants obviously contributing towards the repayment of that loan. That can accelerate that as well. And then typically those clients would have sold that property prior to retirement and then converted that money into another investment asset that will then provide a better return throughout retirement. In terms of managed investments, there's a whole range of them available nowadays. Obviously, the most typical ones would be managed funds, which everyone's quite familiar with. Exchange traded funds have become really popular as well. Um, Essentially, you can buy them like a share on the stock exchange, just like you would buy a Commonwealth Bank share. You can buy a share in an exchange traded fund. The difference is that exchange traded fund will give you access to either an entire market, let's say the Australian stock market, or a particular subsector of the market, which could be regional, say Japan, for example, or it could give you access to healthcare companies across the world. So, exchange traded funds are really a low cost and simple way to get instant access to a particular market or industry, for example. Listed investment companies are fairly similar, except that listed investment companies are typically actively managed and they're typically listed on the Australian Stock Exchange as well. Um, Personally, I'm not a big fan of them, but I know some people use them as their main investment vehicle. Sometimes their value can be different. The way they trade on the stock exchange can be different than their underlying value, which can create some pricing differences. And so, for that reason as well, I'm not a huge fan of them. SMAs, or separately managed accounts, are a bit like a share portfolio uh, and a managed fund. So it's a bit of a mix. So essentially, there's fund managers out there that rather than pooling all your money with other investors basically say, look, with this amount of money, we will build you a model portfolio of shares, but you will individually own each of those shares. So the advantage there is that you have much better control of your tax outcomes, because in a managed fund, essentially, you wear the same tax outcomes as any other investor. Whereas with a separately managed account, you can control that much better. Look, a lot of advisory firms have started using that as their main investment vehicle. Again, I'm not a big fan of it, because I think it's one particular way that you might be locked in with a particular firm, for example. Some portfolios are set up in such a way that it's really hard for you to leave. And also, what I don't like about it is that it's very actively managed. There can be quite a bit of costs as well. So I'm a bit more a believer in passive investment strategies, which we'll talk about later as well. Um, Talked about property syndicates around the issue of liquidity as well. Seen a lot of clients lose money in those as well. Obviously, there's a lot of them that do really well, but it's quite risky because obviously you put money into a particular property venture, which might be a local shopping center, for example, or a hotel, or whatever that may be, or a property development. And there's obviously risks around that in terms of getting out of the fund, but also in terms of what's happening in the wider economy and the effect that that has on that particular syndicate. So we talked about ETFs and listed investment companies. They're not exactly the same, and obviously managed funds again are a bit different. Essentially, it is the way you access them. So, and that can depend on your individual preferences, for example. The fees will be different as well. And then obviously some vehicles like exchange traded funds will be more passive than active. But essentially, it comes down to what works for you and how you want to hold or access those particular investment opportunities. We talked about SMAs and IMAs, which is an individually managed account. So essentially, it's a hybrid of a direct share portfolio and a managed fund. Um, Much better for tax management if that's what you want to achieve. But again, your diversification will be fairly limited compared to a managed fund, for example, because obviously you're not going to have a portfolio of 100 different shares. It will still be fairly concentrated. Property syndicates, again, liquidity is a major issue. Gearing, so typically these property syndicates use gearing as well. So they take your money as a deposit along with the funds of the other investors, and then they use that money as a deposit to essentially borrow more money from the bank to buy a very substantial property. What is really important here, here I think, is the quality and the track record of the provider. So how have they performed in the past? Because that may be an indicator of how skillful they are and how much resources they have and how well they operate. Because ultimately that will determine the outcome of the of the returns and the performance of that particular investment. Finally, just wanted to spend a couple of minutes on other assets, including gold, because a lot of people see gold as a safe haven in these sorts of times. As you can see here from the time of the global financial crisis, how gold has performed over time. Now, that is partly due to the exchange rate as well, because gold is denominated in US dollars, and the Australian dollar has dropped a fair amount compared to the US dollar. So a lot of this increase in price has been due, obviously, to the exchange rate. What we've seen in this new crisis as well is that gold is not always seen as a safe haven anymore, and subsequently there's been a drop in the gold price as well as a result. So I don't like gold in particular because it doesn't pay any income. It's speculative, and so it really, like you can see here, over long periods of time, it can just basically bounce around and provide no asset growth at all. So I see it more as a cultural phenomenon, if you like, where different people in different cultures like to have gold as a resource. Like I said, the main issue there as well is the foreign exchange exposure, and that it doesn't provide any income whatsoever over the life of the investment. Cryptocurrency, I'll be really short. I have no idea what it is or how it works, to be honest. I've looked into it. For me, it looks more than a currency rather than an investment. Again, it doesn't provide any income, so it's not an asset that you can invest and that you can get money from. It's purely speculative at this point in time, I think. So I would personally not see it as an investment. I would see it more as a payment mechanism, albeit one where the value can fluctuate quite dramatically. But for that reason, I have never invested in it myself personally. So, in terms of my philosophy, as you might have gleaned throughout the presentation, I'm a big believer in academics and analytical research when it comes to investments. Um, so, a lot of my clients will have an index based approach for their investments, particularly where the funds are quite low. So, we keep the costs low, we achieve a lot of diversification. Um, we basically keep it really simple because a lot of our doctor and dentist clients have very little time and they just want to make sure their money grows over time at the rate that it should. They're not expecting 20-30% returns. They're really expecting their money to just work for them appropriately over time. Now, we can overlay that, and we often do, with a more active approach through the core satellite approach, where essentially we say, look, a large proportion of your investments will be managed in an index-like way, at a low-cost way, but then we look for more active investment opportunities, typically managed funds, that produce a higher return. So we look for really good quality managers that have performed over time. And then from there, we build a particular portfolio for our clients. This slide is actually from Vanguard. So if you can find more information about the core satellite approach on the Vanguard Australia website. In terms of the coronavirus, look, I don't have a crystal ball. So this is just a statement by one particular Australian fund manager. And a lot of my clients feel the same way. So they see it more as a buying opportunity rather than, at the end of the world. And so a lot of my clients at this point in time are actually looking forward to investing more of their money because over the last 12 months, I have been quite nervous about the state of the share market, and so have my clients. So from that point of view, they have been sitting on a lot of cash, I guess, waiting for the right opportunity to invest, which we don't know might be just around the corner. So look, if you have any particular questions, obviously you can ask them to me, throughout this webinar. But feel free to email me at eves@affluenceprivate.com.au. Feel free to give me a call as well on my mobile 0432 885 295. If you wanted to give me any feedback or get any free ebooks, please have a look at my website, affluenceprivate.com.au. We also offer free strategy sessions. So if you have any particular interest in that, please feel free to reach out and then we can book that in. Look, I hope that this has provided you with some insight and stability within the madness that is going on out there at the moment. But like I said, feel free to contact me personally if you have any particular questions. Thank you for now, and I look forward to hopefully seeing you in person at some stage. Otherwise, please enjoy the free resources on my website. Thank you.